Hey, fabulous. That's enough. All right, 4 eggs, and I'm told, by the way, that they can each sell for $1 apiece. This gives this chicken an earning power, as you've just seen, of $4 a week. So I have to ask myself, how much would I pay to have a chicken like this? The owner, as it happens, is asking $40. Now, if you compare that price, $40, to the earnings, $4 a week, you can see that the asking price for the chicken is 10 times the weekly earning power, which frankly doesn't seem all that unreasonable. Now, let's do the same for a stock. The price-earnings ratio works pretty much along the same lines. First, you've got the P in price-earnings ratio. That's the price of the stock, which is very easy to find. I just look in the paper. When I brought stretch rubber, the price was $20. So we then go to E, which is the earnings per share, which is really just a way of expressing how profitable a company is on a per-share basis. Now, the Stretch Rubber Band Company has 1 million shares of stock, and it recently posted a $2 million profit for the year. So the earnings per share of Stretch, again, you can do this on a pad or pencil. We'll do it here on the computer. You can see that it's $2 per share. Now, that's not money that the shareholders actually get. It's just a way for financial types to talk about profits. Companies release these numbers every 3 months. You can get them from your broker. But to get the price-earnings ratio, what you want to do is divide the price of the stock by its earnings per share. Stretch's price, as we've told you, was $20. The earnings per share is $2. So if you divide 20 by 2, you'll get the PE, and here it is. Voila, it is 10. Now, once you know what the PE is, you have to ask, how do you know if it's a good PE? Well, that's a little difficult to say because different industries have different standards. A good PE for a computer company might be a terrible PE for a rubber band company. Traditionally, for companies that were well-established, big companies, low PEs around 10, 11, 12, 13, they are considered good. But with companies that are growing very fast, where earnings are expected to grow in the future, especially the high-tech firms, you know, the Intech, Protech, Teltech, those kind of companies, higher PEs are accepted. Remember, when people talk about PEs, what they're basically talking about is whether a stock is undervalued or overvalued, or as Goldilocks would say, priced just right. Now, you have to make that decision yourself, but using the PE is a very useful guideline. Now, step number 4, where to investigate. Where do you get all the answers to all these questions? Well, there are lots of places. Use all the sources you can get your hands on. That's what the professionals on Wall Street do, and they are usually the first to know of new developments. Your broker is obviously one source of useful investment information. There are also investment services and books and manuals on investment and scores of periodic investment letters and charts and bulletins. You can get a lot of information from these financial periodicals and from the financial pages of these newspapers. 2 especially comprehensive services that you have heard of, I'm sure, but you've never seen are this one, the Standard & Poor's Stock Report, and this one, which is Moody's. In this case, they're industrial news reports. Now, I'm going to show you a page from Standard & Poor's. Okay, this is the General Motors Corporation. And as you can see, you can find the company's most recent quarterly earnings and its earnings per share. And both these numbers are compared to last year's earnings, so you can see changes over the year. The Standard & Poor's also gives you important news about a company's products and its management and its stock. This is a very valuable investment tool. And finally, there is the most important source of financial information, probably the best investment tool of all. That is the financial report of the company itself. It's so important that we've devoted the whole next section to showing you how to read one.
What are 3 things to investigate before you buy any stock? You should always investigate the industry, the company, and the stock. A company that has 4 million shares of stock and made $1 million in profit has an earnings per share of $4. True or false? False. It has an earnings per share of 25 cents. Earnings per share is the amount of profits divided by the number of shares. If you take a stock's dividend and divide it by the stock's price, you get A, the price-earnings ratio, B, the market price of the stock. C, the yield. C is the answer. You get the yield.
All right, now comes the tough part. We are going to show you how to read a corporate report. Each time you buy stock in a company, there are some things you want to know. You want to know if the company is financially sound, so it doesn't go bankrupt on you. And you also want to know if the company is going to grow and become profitable, because the more money a company makes, the bigger it gets, and the higher your stock's price will rise. Now, you can determine both soundness and growth from a corporation's financial report. Every company whose stock is traded on the stock exchange must open itself to examination by you in the public. The corporate report is a maze of tables, columns, figures, but to make things simple for you, we have chosen the two most important parts, the balance sheet and the income statement. So, I'm going to take a walk and check out a balance sheet. To determine a company's financial soundness, you have got to look at the balance sheet. And what we're going to do here is dig for something called working capital. Now, this here is a balance sheet for the Stretch Rubber Band Company as of December 31st of last year. And I want you first off to notice that this balance sheet on both sides has two sets of columns. One is labeled this year, the other last year. And on all balance sheets, you're able to get an idea of how the company's performance compares from one year to the next. Now, there are two sides to the balance sheet, and they always balance. On the left are the company's assets, and over here on the right are the company's liabilities, and down here is something called stockholders' equity. In order to find out whether this company is safe, I'm going to take you through the full thing, starting with the assets, of which there are many kinds. The first one you will recognize because it's an asset that you have, I hope, you had in order to buy this cassette, money. Most companies have some money, and cash is a principal asset in all firms. Number two, this you probably didn't know. Lots of companies take some of their money and buy stock or marketable securities. It's a convenient way for them to park their cash until they need it. Now, third item, accounts receivable. Remember, this is assets, what the company has. Well, we have lots of invoices. Customers of Stretch currently owe our company for shipments of rubber bands that they got but they didn't pay us for. So that's one example. In any case, it comes to $4 million. Number four is inventories. This is our graphic notion of a rubber band. Raw material is very important in our business, and we have lots of finished rubber goods as well on hand in our factory, ready to use, ready for sale, but we haven't shipped them yet. Stretch may have several shipments of raw rubber in inventory, bales and bales of different sizes of rubber bands ready to go when the orders come in. But for the moment, they are assets in our company, our rubber bands, if you will. Now, you take all these four things together, and you've got total current assets. What we have right now. Fifth category is something a little heavier, literally. Our fixed assets. This is the famous Stretch Company factory building. It also includes our land, our machinery, our office equipment. These are assets that our company uses over and over and over again to make the beautiful rubber bands that have made us famous. But let me tell you that all of these items wear out. They are adjusted on the balance sheet, consequently, for depreciation, because their value decreases as they're used up. In addition to current assets and fixed assets, we've got two other very minor categories. This one here is called prepayments and deferred charges, and that's just, it's like items you pay for at the beginning of the year, like insurance, whose benefits come to the company over the next few years. And down here are intangibles. That would be trademarks, patents, even the goodwill, Stretch's name, very, very marketable commodity. Taken all together, these are Stretch's total